Good morning, everyone. Welcome to another episode of Policy and Profits. I'm Anthony Esposito from Island Capital. Heading into the Easter weekend, we're going to try and stay calm. We're going to try and stay poised, and we're going to get through some news specifically on Jerome Powell. EJ, welcome. I know Jerome is one of your favorite topics and the Fed, so welcome today. Thank you for joining me once again. How are you feeling? How are you feeling heading into the Easter weekend and after the week we've had with the markets and with White House announcements?
Oh, well, you know me, I heart Powell, my buddy Jerome, Slow Jerome. I'm calling it now, by the way. That's going to be his nickname from Trump at some point. Slow Jerome. Anyway, it's been another crazy week. I think overall, I think I'm feeling pretty good about it, though, Anthony, because we seem to be moving in the right direction on the policy side, right? We've talked about this before. It really seems like Navarro, Greer, and Lutnick are kind of taking a back seat, and Bessent, the Treasury Secretary, really seems to be the one who's kind of taken the lead on negotiations and is more or less driving this train, so to speak. So I think that's a positive development overall. I think Bessent has a clearer head, a better head when it comes to these negotiations. And I think he's really got his eye on the prize in terms of what we need to focus on. And he's not letting his, he's staying focused. He's not wandering from one extraneous topic to another. So those have all been positive developments. It's good to see what's the developments right now with Japan, with Italy in terms of cutting deals with them. So that's all moving in the right direction. Obviously you mentioned the Fed chair. He's way out of line, and I think even out of his league at this point. So those are frustrating developments. But hey, overall, I'd say we're in a better position than we were a couple of weeks ago.
All right, well, I have to say I'm very happy to hear you settling down into good old EJ, because when the announcements were made, you definitely, and rightfully so, you were kind of, your hair went up a little bit, and you were a little concerned with the tariff announcements, the way the numbers came out, the reactions that we were seeing, and kind of what it looked like maybe the method, the way the White House's method in implementing the tariffs and coming to those levels, and all justified. I was a little more, I think, because of my market view and what we were seeing unravel in the markets, and I was a little more kind of wait and see, and this is going to work out. But that was probably on the policy side, and I'll insult myself right now, probably more due to ignorance than anything else. You're more in tune with the numbers, the tariffs, the policy effects. So I think you had a little more concern than I had. I'm obviously focused more on the markets, and what was unraveling in the markets to me was inevitable to begin with. So I really wasn't freaking about the tariffs too much. But I'm glad that you're calming down. You look good. You look a little calmer. You sound a little
I've been
calmer.
drinking a lot, so
Excessively.
no, Anthony, I think you're being too self-deprecating there, though, because honestly, you had a great call back in
Thank you.
December. When everyone else was saying, buy, and refused to look at the underlying data, you stuck true to your model and said, look, guys, the numbers are what they are. This was the call. This is still the call. And it goes back to something we've talked about before with these interchangeable headlines, right? It didn't matter what the bad news was. Just as soon as we got bad news, that was going to be the excuse for the sell-off. So, I mean, you were right again.
No, I appreciate that. I actually greatly appreciate that. When we get into the profit side, I'm going to go through some of the returns that we've seen for the portfolio and kind of some developments with the fund now, corporate developments and additional investors coming on. So that's a really good thing, and I really appreciate that. I think the unraveling and the blaming of the tariffs is exacerbated by the fact that Trump's name is attached to it. So we're seeing everybody kind of jump on and make this the issue, and they're not going to let go of it, as they do. And I think Powell has stepped in and has shown himself even more so to be a political hack, which is becoming extremely frustrating. I mean, we can go back to September with the 50 basis point cut and move on, and we can go further back than that. But he's really outdoing himself as far as somebody who's undeserving of the position that he's in. We'll go to the first clip. That's probably a great segue of Powell speaking this week. Crushed the markets, a 2.5%, 3% sell-off intraday based on comments from Powell. Um, let's go to that clip and let's have a little comment back because we might as well dig in on this guy.
It's very helpful. The reason we do it is it's really good for U.S. Consumers. So we'll continue to do that, just as part of the dollar being a reserve currency, the reserve currency, most important. And we will do that.
You mentioned amongst the issues you were focused on was the U.S. fiscal situation. Well, clearly, U.S. sovereign debt continues to rise. And what are your thoughts on the longer-term implications for interest rates and economic stability? How much further can we go in terms of national debt before we cross a line that might be unsustainable in the long term?
So the U.S. federal debt is on an unsustainable path. It's not at an unsustainable level, and no one really knows how much further we can go. Other countries over time have gone much farther, but we're now, we're running very large deficits at full employment. And this is a situation that we very much need to address. Sooner or later we'll have to, and sooner is better than later. In terms of, if I can say from my time working on these issues, it's not the Fed's issue, but if you look at a pie chart of federal spending, the biggest parts and the parts that are growing are Medicare, Medicaid, Social Security, and now interest payments. And so that's really where the work has to be done. And those are issues that can only be touched on a bipartisan basis. Neither party can figure out what to do without both parties being at the table. So that's critical. All of this domestic discretionary spending, which is essentially where 100% of the conversation is small as a percentage of federal spending and is declining it's already declining as a percentage of federal spending.
So I'm going to pitch this to you and dish it to you and let you make comment. I'm going to make a very quick comment on this. And it is extremely frustrating as an asset manager to listen to a man who just months ago, prior to Trump coming in, say, I will not comment on fiscal policy. Listen to a man who sat next to Yellen as she oversaw 16 trillion in debt created. He's talking about a national debt that is now 120% of GDP, 125% of GDP, had nothing to say, nothing about fiscal policy, debt, or the influence of our national debt and deficit spending on inflation, but now understands the whole landscape and can really nail it down and define the Fed's fit or the Fed's role in this entire puzzle of debt, deficit spending, inflation, consumer spending. Now he's got it all figured out. Please explain in your eloquent way how ridiculous this man is.
I am going to try as hard as I can to be charitable and measured since it is the Easter weekend here. Let's kind of walk through Jerome's history. He was the chairman under Trump and was steadily increasing interest rates and selling off the balance sheet because he thought that somehow the economic growth that Trump was creating was going to cause inflation, which is the most silly Keynesian idea ever, but that's what he buys into. So he over-tightened, so much so that in September of 2019, we actually had a crisis in the repurchase agreement market. And a lot of people forget about this because COVID happened right after that. But the Fed actually had to conduct a $500 billion bailout of hedge funds at the time, of leveraged hedge funds. And again, everyone forgets that happened because it was only a couple months later, as they were still undergoing that process, that we got COVID. In fact, in the 2 weeks before the Fed went on this buy anything and everything spree because of the economy shutting down from COVID, 2 weeks before that, the basis trade had started to implode because of what the Fed was doing with interest rates, and they were stepping in yet again. So the idea that somehow Powell did a great job even before COVID is a fallacy. He did a terrible job. They bought way too much in terms of securities, adding to the balance sheet in 2020, and they continued to do that throughout 2021. They continued to keep interest rates artificially low, and even though they were buying so much and adding so much to their balance sheet and keeping rates near zero, they were still having a difficult time controlling those rates. And that's why we ran up $2.5 trillion in terms of reverse repurchase agreements. So not the repurchase agreements, but reverse repurchase agreements. And we've had that discussion a couple times now. Essentially, that was them trying to keep a floor on interest rates. And what did this all do? It caused the highest inflation, the fastest inflation in 40 years. It was a complete disaster. And then, because he was up for renomination, he wasn't raising interest rates because he wanted to try to assure that rates were going to stay artificially low, lest he maybe not get renominated under Biden. And while he was in the process of getting reconfirmed, he was in those nomination hearings and everything, or renomination, I guess. He told us that rates were going to stay low and a 75 basis point hike was off the table. That's what he told us. And as soon as he got confirmed, as soon as the Senate voted him back in, he delivered 4 of those jumbo-sized, those emergency-sized rate hikes in a row. Mm-hmm. And this caused all kinds of turmoil in the financial sector. Banks, because he assured them rates were going to stay low essentially forever, banks loaded up on tons and tons of 30-year securities, treasury bonds, and now they were stuck with these assets on their balance sheet. I use the term assets very loosely there, but these things had only a couple of percentage points annual yield. And now the banks are turning around in a 5% interest rate environment and having to pay 5% to their depositors. Yeah. And so that's how you very quickly get on a path to insolvency, and that's where you get Silicon Valley Bank and First Republic and several other banks that started going under in the spring of 2023. So he managed to cause a banking crisis on top of it. Fast forward to 2024, before the election, and we talked a bunch of times, even in early 24, about how the market was pricing in. What was it, Anthony? Something like 9 or 10 rate cuts at one point in the year ahead. Yeah. I mean, these ridiculous numbers that we were essentially just going to march all the way down a quarter percentage point at a time, 25 basis point cuts until we got to like 1% or something. Yeah. It was obscene. And that never happened. And then right before the election, as markets were like, oh my gosh, maybe this isn't going to happen, what did they do? They initiated a series of cuts, again, right before the election, including a 0.5 percentage point, 50 basis point cuts. That's something that you, again, reserved for emergencies. But they wanted to get their preferred candidate across the finish line, the Democrat, and that didn't work out. And then all of a sudden, with Donald Trump back in, now we return to this whole narrative of, well, interest rates are going to be higher for longer, something they completely gave up on, again, right before the election. And as you rightly pointed out, Anthony, when Powell was repeatedly asked about the deficit, about Biden's crazy levels of spending, he always said, look, it's not our job to comment on fiscal policy. And if you want to take that posture as the Fed chair, okay, by all means, go ahead. I'm okay with you doing that, provided you stick with that.
Stick to it, yeah.
And exactly. And clearly he hasn't. So if he's going to talk today about high deficit levels, where was he for the last 4 years under Biden when the deficits were just as high, when all of the spending was happening that was causing these high deficits? And the last thing I'll say, and this is where I really think he's got to go at this point.
Yep.
In that clip we just played, he's talking about what are frankly political poison pills, cuts to Social Security, Medicare, and Medicaid. Anytime a politician starts talking about that, what happens? Their polling immediately goes down, right? So what he's basically saying to Trump there, he's essentially saying, look, here's the deal, buddy. You either commit political suicide or I'm going to keep interest rates where they are. You're not going to get any cuts. So essentially, he's telling Trump, look, you either do the impossible or you're not going to get what you want. So he's basically, giving a big middle finger, essentially, to the president at this point. And sorry, I lied. I will end with this. One last thing. If Trump really wants to get rid of Powell, and this is something that, he has every right to do, I think, legally, he can remove him for cause because Powell has actually been violating the law in how he's funded the Consumer Finance Protection Bureau. It's the only organization that doesn't get its money from the normal congressional appropriations process. Instead, it gets its money from the profits at the Fed. The Fed hasn't had any profits since the fall of 2022.
You actually have a great graphic on this. This was out on X, and we have it to pull. And I want to dig into this for a couple of minutes here because this is really important. So we'll get that graphic up. So go ahead. I didn't mean to interrupt you, but continue on with this because this is super interesting.
So the Fed hasn't had any profits, like I said, since I think it's like September of 2022. And when the Fed runs a profit, what it normally does is it pays its expenses, right? And then it hands that money, what's left over, the profit, over to the Treasury. And we don't call them profits. Like if you go through the Fed's balance sheet, you're not going to see that word anywhere. They're called remittances.
Yeah.
And this money is due back to the Treasury. Now, when the Fed runs negative profits or it runs at a loss, it doesn't have any remittances. Instead, it accumulates what's called a deferred asset. Now, because you're the Fed and you get to write your own accounting rules, you call a loss an asset, but whatever. This deferred asset is then essentially just wiped out as soon as the Fed turns a profit again. And this happens on a weekly basis. So it's not uncommon. You might have 1 week in particular where the Fed doesn't have a lot of money coming in because of the timing of maturity on different securities. That's especially true for things like bills, T-bills, where you just get all the money at once, a lump sum when the security matures, as opposed to a bond where you get that 6-month coupon payment. So whatever the case, what's unprecedented is running a continuous loss week after week after week and in very large volumes. That's precisely what happened when the Fed, which had loaded up on all of these low interest rate securities, all of a sudden found itself paying higher and higher rates in order to keep money sterilized. So they did that through this crazy policy of paying interest on reserve balances to banks, but also using the reverse repurchase agreement market for something it was never intended for, which is to just permanently keep a lot of money sidelined because their balance sheet is way too big relative to interest rates. Now, as the balance sheet has come down a little bit and as interest rates have gone up, that's helped drain the reverse repo facility almost to zero. There's still a little bit left, but not much. Conversely, though, they're still paying tons and tons of money on billions and billions and billions of dollars in reserve balances. So the Fed has basically at this point accumulated over $225 billion with a B in losses, which means they're going to have to essentially have profits for years and years to wipe out that deferred asset before they're going to send another dime to the Treasury. So in this way, the Fed has actually contributed to the federal deficit because the money that normally would go to the Treasury, which essentially works like tax revenue, right? It's on the addition side of the balance sheet, on the income side, I should say, not the outgoing side, not the outlay side. That's now gone, and it's not going to return for many, many years.
That's amazing. All right, so for cause, Powell can be fired. If Powell can't be fired for cause, which kind of looks like that's game, set, match. And look, if I mean, in a way, I place bets all day long and all month long. But if I'm going to place a bet on Powell or Trump and who's going to win in a battle of the minds and wit, I'm loading up on Trump. I'm shorting Powell. I'm long the near dated puts. I'm long the leaps. I'm short calls. I'm as negative as I can be on Powell in that conversation. Super interesting, and definitely gives Trump a reason to fire for cause. If not fired for cause, then I know you and I talked about this earlier. If there's a vacancy within the Fed, Trump can nominate Powell for that vacancy, and if he refuses that nomination, then he's dismissed. So there are ways for Trump to remove Powell. And to be perfectly honest with you, anyone that is in an appointed position that is being told by the President of the United States that he wants them gone, they should be leaving. This mere fact that he's demanding his seat and demanding not to leave absolutely disqualifies him, in my opinion. So we can talk about all the facts and his actions as far as being political and biased and irresponsible, and that's fine. But the mere fact is, if you're appointed and you're being told by the president that he wants you to leave, you leave, and that's that. And if you don't leave, then there's you have another motive. You can't stand there and say that you you can't be dismissed. You can, you should, and you should leave. And that's that. So we have another hit from Trump, comments on Powell and the ECB. The ECB, interestingly enough, I was taking a look at the map of rate cuts, cuts, rates being held steady and rates rising.
Mm-hmm.
And Western Europe, the ECB right now, in addition to one or two minor countries, South America, the ECB is the only bank cutting rates currently. Now, that's not to say that China's not manipulating the markets and supporting the markets. They pumped hundreds of billions of dollars into supporting
Right.
their real estate market, their equities markets, their banking system last year, and they continue to do so. And they should, because they're in trouble.
Mm-hmm.
The European Union's in trouble. ECB, the only bank actually cutting rates. Trump here stating ECB has cut interest rates for the seventh time. Too late. What'd you say? Too slow, Jerome?
Slow, Jerome.
Too late, Jerome Powell of the Fed, who's always too late and wrong. Oil prices are down. Groceries, even eggs, are down. The U.S. is getting rich on tariffs. Too late should have lowered interest rates like the ECB. Powell's termination cannot come fast enough. I don't think Trump
termination, right?
termination,
Not resignation. Termination.
Well, semantics.
I don't know. I don't know. Did Trump choose that word very purposefully?
Every word he chooses is chosen for a reason. I have no question or doubt about that. I don't think Trump is wrong. Just to reiterate what we're saying here, President Trump has an agenda. President Trump agenda is truly with cleanup in aisle 7, and I keep saying it. And I've said a number of times this week that the markets, the equity, the risk markets are the mop. So they're going to see all the dirt and all the mess as we're cleaning up. There's no question. That's the kind of like everyone's barometer, right? Like everyone's barometer is how do you feel when you sit down at your kitchen table, and what do the markets look like? And that's kind of what everyone looks like. So I think President Trump's agenda is headed in the right direction. There will be a mess. And we've been saying this for over a year on this show in particular, where the implementation and change of policy, which is wrong or outright deceitful, smokescreen, and then effective a policy is going to take time. So the implementation to effect takes time, and walking across that aisle to get to the effect is messy. I don't think there's anything wrong with that. It's actually what we need to be doing. And I think if Jerome Powell's not on board to help the effort and to help the United States of America and to be objective and to be kind of a part of the solution, if you're a part of the problem or even not a part of the solution, you need to leave. And I think Trump here is calling it out. And to your point, forecasting what the end result will be for Mr. Powell.
Yeah, and look, the president, obviously, when we're talking about the executive branch, the president deserves people who are essentially in line with his agenda and are there to help him. And if you're in the executive branch, you serve at the pleasure of the president. Now, I understand the Fed is a quasi-public-private institution, so it's not even part of the executive branch. But at the same time, the Federal Reserve Act is pretty clear, not only in terms of how the Fed chair gets appointed, but also the functions of the Board of Governors. And look, the Fed chair needs to work hand in glove with the Treasury Secretary. For the time being, at least, it seems like that at least is happening, because Scott Bessent, from what I hear, has been defending Powell in private. Essentially, he's the only thing preventing Trump from telling Powell, get out, and sending in security guards to drag him out of the office.
Yep.
But I think as soon as Powell's rhetoric, I should say, as soon as Powell starts shifting a little bit away from rhetoric and to reality, in other words, when this isn't just words, when he actually starts putting the screws to Treasury markets, I think that's when Bessent is going to say enough is enough. And at that point, Powell won't have anybody left to defend him.
Yeah.
Look, we're in a precarious time right now. The Treasury market, I understand it's still the deepest and most liquid market in the world. I get that, but it's also very stressed. Yeah. The violent swings that we have seen in yields right now, just in the last few weeks, just literally this month, in the month of April, that's been pretty dramatic, and that's not a good sign. So you need a very, very good and well-functioning relationship between the Fed and the Treasury. And if that ever breaks down, I mean, I think Powell could literally, if you have an event of some kind, I think Powell is literally gone in less than 24 hours after that happens.
Let me ask you something, and this is a real important point. Without going crazy deep down the rabbit hole, the relationship between the Treasury and the Fed. Let's talk for a second about the demand to cut the Fed funds rate, and is that related to the amount of debt that we need to refinance? What are the numbers there, and is there a reason why Powell should be cutting rates in that team effort with the Treasury because of the amount of treasuries that we need to refinance?
Really, really good question. So, and it's kind of tough to answer in terms of which way should interest rates go. But the solid numbers I can give you, Anthony, are if you look at the amount of debt that's got to be refinanced this year, so the stuff that's going to mature, plus the debt that's got to be issued. So the total, the total net issuance, if you will, you're looking at, or I'm sorry, that'd be gross issuance, I guess. Net issuance would just be just the new debt. So total auctions by the Treasury, stuff that's rolling over and brand new deficit that's got to be financed. You're looking at $10 trillion this year. I mean, that's just staggering. Now, granted, a good chunk of that are bills, and some of those bills are going to roll over more than once during the year, right? Because the longest bill is only 52 weeks maturity. But still, this is a huge market, and if that ever stops functioning well, you're in trouble. Yields are really going to spike much more than they have the last the last couple of weeks. Now, in terms of what the Fed should be doing, if they're going to move on interest rates, they have to move, I think, in the opposite direction somewhere else. What I mean by that is you don't want to get back into a situation where the Fed is cutting rates and buying tons of government bonds and flooding the system with more cash. You could theoretically, I think, start buying up more treasuries if you're going to sell off the mortgage-backed securities faster. You could move on interest rates if you stop handing out cash to Wall Street via the reverse repo market and the interest on reserve policy. There's no reason why you need to pay interest on reserves. You can simply go back to having a reserve requirement. So instead of incentivizing banks through these interest payments to, let's say, keep maybe a quarter or a third of the money in reserve, just require that. That's what we had before March of 2020. There was simply a legal requirement. You will keep this ratio, period. End of story. And I understand Bernanke went down the whole rabbit hole of paying interest on excess reserves, but now we've kind of reached the logical conclusion to that. So, the Fed could save billions of dollars and stop adding billions of liquidity to the system if they cut those policies out. The other thing is that as soon as we have a better sense that we're going to start cutting the deficit and cutting it significantly, interest rates can come way down. Because what's the interest rate? It's the price. It's the price of the loanable funds market, the price to borrow money. So if you reduce the demand for borrowed money, you're going to put downward pressure on prices. You can lower interest rates that way. The other way would be increase the supply, right? You raise the supply of loanable funds. Well, how do you do that? You can do that by cutting taxes, actually. When people can keep more of the money that they earn, that results in people having more money to spend, but also more money to save. And so you can increase the supply of loanable funds, the total loanable funds market that way as well, which also helps put downward pressure on interest rates. In other words, the vast majority of the Trump agenda is actually anti-inflationary and supports lower interest rates. I understand you can make an argument about tariffs, but even still, the total volume of tariffs is going to be something like 1/10 of the size of this tax cut package. Yeah. I mean, that's negligible before you even start talking about the deregulatory agenda, which is also pro-growth and anti-inflationary. So, look, again, I think there's a way to do it. I think there's a way for the Fed to get interest rates down. But actually, I think the broader point here, Anthony, is that the Fed shouldn't be setting interest rates in the first place. Yeah. I think the only interest rate the Fed should be setting is the discount window. when banks have to come to the Fed for emergency rates. And that's a pretty easy one to set because you can just look at market rates for things like the 10-year Treasury and say, all right, we're going to charge that plus a 300 basis point premium, whatever the case may be. So again, the Fed should not be trying to lead markets around by the nose. Yep. The Fed should be following markets, in my opinion.
Yeah, absolutely. And we've been saying that for a long time. And I mean, along with the fact that the 10-year yield is really where the focus should be as far as what we're paying on money, what the real cost of borrowing money is, whether it's car loans or the 30-year fixed or credit card rates, what have you. That's kind of where Besson's focus is. I think your point is great. And it is me asking you not to go down the rabbit hole is probably silly because it's complicated, but
I know no other way.
No, I love the rabbit holes are great. But essentially what we're saying is the Fed could leave rates exactly where they are. And we've always said that headline is just, it's just that shiny ball. I'm just so sick and tired of hearing about it. But as far as what you're saying, essentially what you're saying is rates at 5% don't matter. Rates at 5.25 don't matter. What matters is what is the net effect of liquidity in the system. So if we have reserve requirements and if the Fed is buying assets but also selling assets and they're keeping liquidity constant or their net liquidity is holding and then they're requiring reserves at the banking level, which is what we had prior to COVID, that should help in bring rates down, effective rates down, regardless of what the Feds do with the Fed funds rate. That's essentially where we're at, right?
Yeah, exactly, Anthony. Okay. I think that's a very good summary. Absolutely.
Okay.
And unless we get to a point where the Fed is back to following markets, right, instead of trying to lead them, and the Fed works much closer with the Treasury, you're going to continue to have not just this infighting in the administration, but you're also going to have these crazy arbitrage opportunities where we've gone back and forth here, where in the one case, a bank can use the Treasury market and then arbitrage that with the Fed funds rate. In other words, borrow from one market and then park their money at the Fed, essentially. So yes, they're paying on the one side, but they're getting more in terms of yield on the other side. Or they do the reverse, where they simply borrow from the Fed, but then they turn around and lend it to the Treasury. So you're essentially getting to borrow money that was made out of thin air, and then the taxpayer has to pay you interest on it. So again, these crazy arbitrage opportunities, and we've gone back and forth between which way the money's flowing, but that shouldn't be happening.
No. And look, the bottom line is, and that's very true, the bottom line is, and I'm going to quote Frankie Tofano from 1998 in the Blue Room, who was one of my $2 brokers when I was first starting out on the floor of the stock exchange. If you're not going to help, don't hurt. And the other quote was make it work, but that's probably applied somewhere else. If you're not going to help Jerome Powell, then just step to the side. Don't hurt. The American people deserve better. The president deserves better. But more important than that, the American people deserve better. This is not a pissing match between you and President Trump. You're not at that level. So if you're not going to help, don't hurt. I want to end this with a comment from President Trump, which kind of sums up where he's at as far as Mr. Powell.
On Jerome Powell, you said that the termination of Jerome Powell cannot come fast enough. He says he won't leave, even if you ask him to.
Oh, he'll leave. If I ask him to, he'll be out of there. But I don't think he's doing the job. He's too late, always too late, a little slow, and I'm not happy with him. I let him know it, and if I want him out, he'll be out of there real fast. Believe me.
I don't doubt that for a second. By the way, if he's asked to leave, he will leave, and that's that. Whatever the headlines are, however Powell wants to paint it, if you're told to leave by President Trump, you're leaving. Last word on this. What do you think? You agree with that?
Anthony, I think you're absolutely right. I think you're spot on here. There's no way this ends well for Powell. Do you really want to be the first and only Fed chairman who was fired from the job? I mean, do you really want that? I don't think so. I think it'd be much better if he were to just give that typical face-saving letter of resignation, saying, "Look, the president and my priorities are not aligned. Blah 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 blah. So I resign."
Yeah. And he'll do the same thing Yellen did, wave on the way out and say, by the way, here's the grenade. I can't find the pin, which is exactly what Yellen did on the way out. She
Yeah.
walks out telling you might want to think about the, debt levels. They're getting a little big. Thanks. Thanks for the help. So I want to go into profits a little bit here and shift gears to the market. There's a few things going on. I've had some comments and some questions back. I write my morning note. It's out on X. It's out on my website, islandcapitalinvestments.com. The subscription's free, and you can kind of see where I view the S&P 500. The portfolio is run basically on 5 assets. The S&P 500 futures is one of those 5, the way I realize the trades. And I run my model, as you know, in a top-down technical way. It's a rule-based model. It's not a quant or a black box, meaning I can see trades and signals that I choose not to participate in, but I'll never trade against the model. The model for me has done very well. These headlines, these topics, whether we're talking about AI, whether we're talking about inflation, whether we're talking about tariffs, I honestly, to some degree, I don't care. I care because I look at the fundamentals of the market and try and figure out that with my 30 years of trading experience, with my technical knowledge and my model, I figure out where it looks like it's going to go, what the probabilities are. But essentially, I don't care what the headlines are. Full circle, year to date, the S&P is down about 10%. We are up at Island Capital as of the close of business Friday. We're up 32% on the year, which has been a fantastic year. The volatility has been well forecast by my model, and we've managed well here to take advantage and not get kind of hurt with the back and forth whipsaws of headlines as we've come down through the real drawdown that we've seen. And as you said earlier, we started to see the need to be short risk assets and long volatility from back in December, and it's worked out well. That said, we are going through a little bit of a corporate change here and a structural change. So we're taking on new investors. There may be a change in name. So Island Capital may become a new fund. We'll let everybody know what that name is, and everything will kind of roll over to the new fund name as that happens. But we're having some good things happening here, and we're really excited about it, to be perfectly honest with you. As far as the market goes, we saw that peak to trough drawdown of 21%, which was well forecast and got very aggressive after the tariff announcement. There's no question. That brought us down to close to 4,800 on the S&P, and we can pull up that first chart we have of the S&P. That was kind of like a broader zoomed out chart. So this is that move down, 21% down. We were up at 61.47. We had labeled that as resistance. We had actually done some Fibonacci work, and I'm really focused on using the March 2020 low as the base of all my regression work. And we've shown these charts before, and we showed a few months ago, actually, probably back in, well, actually it was in February, because we marked the top at 61.47 essentially that week, which is insane. That was a 50% extension, and that ended up being the ultimate top. But we've seen this drawdown. 4,800, if you're reading the report, has been a highlighted and focused support level. We came within 34 handles of that. We've had a nice rally back up. I've been writing consistently about not chasing rallies, but being a seller of rallies, being patient, being strategic. And that's worked out well. 5,400 to 5,500 is the current resistance range, or near-term resistance range on the daily. That has now started to work again as a spot to get short or to get out of anything you might have bought on the rally. Again, I am not getting long on the rally because I haven't gotten any positive daily signs, and my signal on the intermediate and long term remains broken and remains negative. So I'm not a buyer of any of these rallies. Typical bear market rallies, we've had some really big days. That one day on April 9th, we had a 13% rally up, still hitting our head 5,400, 5,500. I do believe that, and we can go to the zoomed in chart now on the daily just to give a closer look of what I'm talking about. I do believe that we're in position here to fade further. I know there's a massive headline risk. I was talking to a good friend of mine who trades down in Dallas for an energy fund over the week. And, the question is, how do you manage now assets when you're literally trading the S&P, the Russell, crude gold VIX, but the headline risks are so massive. At this point, what do you do? And to be honest with you, the answer to a large part comes down to sizing, which is what people don't normally look at. But if you size your positions right, which we try and do here, you can put yourself in a position to continue to win, limiting losses, but being able to let the winners work, and the rewards are there, the returns are there, and that's what we've seen as we broke from the higher levels down, and the signal was really, I'll say fat because I don't have a better term. That's kind of the way I look at it. You know, we have a leveraging model where we can leverage up to certain levels depending on how fat the signal is. And at those higher prices on those breaks, the signals were really fat. We were very levered. It worked in our favor, and that's how we ended up 32% on the year. Here we could see a signal even down 15% from the peak. That's as fat. We're not seeing that right now, but I am seeing enough of a signal and a turn. The model on the daily is neutral. I see other signals fading. It's a signal we want to be short, but not as levered as we were at better signals higher. It could become that signal, and this could become a fully levered signal here, or down slightly or up slightly. But right now, we're looking at a relatively, 1.5 to the allocation for S&P short, and we are short here. So I do think that we're in neutral. I'm not adding any more here, but on a break to negative, I will add. And I do think that this move is set up easily to test 5,200 or 4,800 on the daily, and then, or in the near term. I do believe that our targets of 4,200 and 3,700 remain in place. Those targets again are retracement levels for the entire move from the March 20 lows to the highs. They bring us down to a 50% retracement and then a 61% retracement of those moves. The 3,700 level for me is extremely important. And it is important. I'm going to pull up one quick report. It's important to me because it represents the lows from November of 22. Now, the lows from November of 22 for me kind of are a sticking point, because I feel like those lows came off of the Fed tightening, as you said earlier. They said they wouldn't lower forever, and then they started to tighten. Russia-Ukraine happened. Geopolitical risk got priced in. The market started to really pull back. There was also, if you remember back at that point, commercial real estate in China, there was some real cracks in that. So there was a lot of concern globally, and there was a lot of concern just with the Fed and inflation and rates. That low held because of the creation of the AI narrative. And I hold to that story, and I've said this. I was saying this back on TV in December and January. I said it specifically the day that DeepSeek hit, and we saw that big drawdown in the S&P, which eventually recovered, started to creep the top of the top, and we broke. I think that this AI narrative and story and inflation of the market with very narrow breadth started at the lows in 22. The way my mind works and the way these regression levels have worked, I like to see things overlay. I like to have multiple reasons why levels make sense to me. I don't want to just pick a level and say, okay, I think that's a level, especially in a case where you're trying to draw out what a 10 to 5 year retracement could look like, right? When I see one view of mine or one indicator or one overlay hit 3,700, and then I run a different process and a different indicator or layover, and that hits 3,700, and then I go to a third one. I'm like, well, I'm going to look at this too, because this is part of my process, not part of my model, my momentum trend model, but part of my process. And then that hits 37.20, and I hit another one that hits 37.15. I'm kind of like, I'm getting there, like I'm being convinced. I am convinced by the time this cycle ends, by the time this bear ends, we will be at 3,700. It is not an egregious level. Look at it for what it is. The market has been on an absolute tear from the 20 lows. We've been on a tear from the 22 lows. It's time to kind of reset, and there are reasons to reset. So from here, near term, I do see 5,000 to 4,800 being tested again in the near term. So for me, that's, a 2 to 4 week period. I do think that by the time the cycle ends, which could be a 3 to 6 month period, we should be down at 4,200 and 3,700. And I think that kind of will bring us to the end of the aisle of cleanup, which will bring us to starting to see that those, that kind of V-shaped recovery in the economy where policies are starting to take effect. The additional investments that we've already seen are being implemented and are kicking into real jobs growth, real GDP growth. There'll be additional onshoring manufacturing in the United States that will help. Hopefully taxes and the tax bill passes. We're in a better place there. That will help. Hopefully we have a new Fed chair that will help. And we kind of are moving into essentially out of President Trump's term and into a second like-minded administration that will continue the policies and continue growth. Not to be too crystal ball, but that's kind of how I see it playing out. So I would be really cautious here in chasing rallies. I do believe we're in a bear. I do believe we have much lower to go. We are literally, 15% off, 14% off of all-time highs with a market that was begging to be sold and begging for a reason to be sold. And that's where we're at. So that's kind of the breakdown on Island Capital and where we are corporate-wise and kind of directionally. That's my breakdown on the market for this week. I think there's a lot going on, a lot to be conscious of, but that's the zoomed out technical view. Remove the headlines. Objectively, this is what my model and the numbers are showing me.
That's a great analysis, Anthony. I mean, just spot on from soup to nuts. Really, really love it. And I know you were talking about S&P futures, but you mentioned that you have five things that you trade all together, and VIX is one of them too, right?
I trade, yeah. So what people don't realize is you can't really trade spot VIX, which seems it's kind of weird because people see the VIX and the fear indicator or the fear model, and it's talked about all the time, and very few people really understand the VIX, term structure of VIX, or the derivative products that are based on the VIX. So I do trade the VIX. I trade the VIX through front month VIX futures. I do have two volatility or VIX models that I track. One is based on spot VIX, and it's a spike model based on day counts and new highs in the VIX. And I do use that to trade. So my long VIX would be short equity and my short VIX would be long equity. And that is something that I use here as a guide, and I do put trades on based on it at times. And then I have a model where I measure term structure, and not to go too deep into it, but it is a slope measure of spot VIX front month, second month. So as you move up the curve, what is the slope of that curve, whether it's negative, neutral, or positive for me, meaning typically VIX is in contango. So VIX is very settled and contracts are rolling down to VIX, which is lower, which means there's less fear and equity markets are going higher. That's 85% of the time, call it. And then the VIX can shift into a neutral position, and then it can shift into backwardation where spot VIX is actually spiked, which is what we've seen now. And contracts are actually rolling up to spot VIX. So the front month, second month are actually lower or trade at a discount to spot VIX. So I do trade volatility, not in the implied vol options world, but I trade VIX volatility through front month options. And that's been a very profitable part of the portfolio. It is an aggressive trade. So again, sizing is important. You want to kind of vol weight, no pun intended. You want to kind of vol weight your vol trade, because the VIX could move on a real hard down day in the S&P. Let's call it a 3% down day. You could see that front month contract move 20%. So wow. You want to be sized properly, and you want to really understand the curve and how it works. But yes, it's a big part of the portfolio, and it's something that I concentrate on, partially because most people don't get it or concentrate on it. And then there's fat ways to realize the trade. I'll say this real quickly, where a lot of retail money will go into like the VXX because they're not accessing the futures market, nor does people even know that they can access the futures market. They're buying VXX thinking they're buying a product that's matching VIX, but they're actually buying VXX, which is a product that's being priced on front month, second month futures, which is another part of the confusion with people with VIX. I will say that because retail money can go into VXX very easily, and even institutional money can get into VXX very easily. When it moves, potentially there's more of a move in it because you get much more of a demand into the product, and they just push it. It moves quickly, whereas less people are actually trading VIX futures. So different ways to realize the trade, but I am in the VIX. I do trade volatility, and I realize that trade through front month contracts and at times an ETF like the VXX.
Fascinating stuff, my man. Absolutely fascinating.
Thank you.
So I am always blown away whenever you go into the market, just not only your depth of understanding of it, but every time we have one of these discussions, I'm learning more and more about these different financial products, these different derivatives, like you were talking about, what they are, how they work, and how they can be traded. In your case, how they can be traded successfully.
Well, we'll keep that going on Easter weekend. I'll continue to pray and continue to focus on the model and stay objective and stay grounded. But definitely appreciate it. Always a pleasure, and honestly, likewise, you've been a huge help with the policy side of things and what the macro and the top-down view looks like. So greatly appreciate your time, your expertise. It's always a pleasure, and I look forward to the next time, my friend.
Pleasure's all mine, Anthony. Happy Easter to you and yours.
You too. Thank you, sir. Yes. Yes. So I want to jump into one more just to end this nice and tight as we head into this Easter weekend. We've had the How Dumb Is section of the show, which I actually get a kick out of. This week is not how dumb, it's how wonderful are our children. And my wife and I have 4 children, one beautiful, I'll call her little girl, but she's going on 17 now. I've had many of these experiences with her, and they are some of the most special that I can recall. They're just wonderful moments. So how wonderful are our children heading into this Easter weekend?
You're excited. I can see him.
So great. So great. That's what we're missing. That will put everything else in place. That's what we're missing.
Amen, Reverend. I tell you what, hey, you know what? I know you said, this case isn't how stupid, it's how wonderful. But I guess the correlation here for how stupid is, how stupid are those people who say, no, I don't want that. I just want stuff, right? Who spend their whole life not, and I understand some people can't have kids. This is not a knock on those folks, but the people who willingly choose, right? Who are like, no, I just don't want a family. Do you have any idea what you're missing?
No, it's definitely, it's a wonderful thing. And it's something that we really, as a Western society, should really start to focus more on and put ourselves in a position to, succeed as a people and as a society. It is truly the foundation of everything else.
Amen, Reverend.
All right, brother. Have a great Easter. Love it. Thank you. And talk to you next week.
Happy Easter to you and yours, Anthony.
Thanks, man.